At the turn of the 21st century, one company seemed to represent the future of American capitalism. It was bold, innovative, and endlessly ambitious. Wall Street admired it, politicians praised it, investors rushed to buy its stock. The company claimed it had reinvented the way energy markets worked. Instead of simply producing or transporting energy, it had turned energy into a financial product that could be traded like stocks or bonds. For years, the strategy appeared to work brilliantly. Revenues surged, profits appeared to grow rapidly. The company's stock price soared higher and higher. Business magazines celebrated its executives as visionaries. Investors believed they were watching the birth of a new kind of corporation. But behind the scenes, something very different was happening. The company's profits were not nearly as strong as they appeared. Hidden beneath complex accounting structures and opaque financial partnerships was a growing mountain of debt. Instead of reporting those problems honestly, executives found ways to hide them. For years, the illusion held. But when the truth finally surfaced, the collapse was swift and devastating. The company was Enron, and its downfall would become one of the most shocking corporate scandals in modern history. To understand how Enron fooled Wall Street, it helps to begin at the beginning. Enron was formed in 1985 after the merger of two natural gas pipeline companies. The deal was led by an economist and executive named Kenneth. At the time, the company was fairly ordinary. Its main business involved transporting natural gas through pipelines across the United States. It earned steady but relatively modest profits. But the energy industry was beginning to change. During the late 1980s and early 1990s, the U.S. government began deregulating parts of the energy market. Prices were no longer tightly controlled. Energy could increasingly be bought and sold through competitive markets. Kenneth believed this shift presented a huge opportunity. Instead of just transporting energy, Enron could become a powerful intermediary in the new marketplace. It could buy and sell energy contracts, connecting producers with consumers. To help execute this vision, Enron brought in a brilliant and aggressive consultant named Jeffrey Skilling. Skilling had a radical idea. Energy, he argued, should be treated like a financial asset. Just as traders bought and sold commodities, currencies, or stocks, energy could be traded through complex contracts. Companies could hedge risks, speculate on prices, and lock in future energy costs. If Enron positioned itself at the center of that system, it could profit from every transaction. The concept transformed the company. Enron began building one of the largest energy trading operations in the world. Traders inside the company bought and sold contracts for electricity, natural gas, and other commodities. Soon the company expanded into even stranger markets. Enron experimented with trading broadband capacity, weather derivatives, and even water rights. To support this strategy, the company created a powerful online trading platform called Enron Online. The system allowed customers to instantly trade energy contracts directly with Enron. At its peak, billions of dollars in transactions flowed through the platform every day. The company's growth appeared extraordinary. Annual revenues exploded from just a few $billion to more than $100 billion within a decade. Wall Street was impressed. In 2000, Fortune magazine named Enron America's most innovative company for the 6th year in a row. Its executives became celebrities in the business world. But inside the company, pressure was building. Investors expected constant growth. Quarter after quarter, Enron had to deliver strong earnings. If profits slowed, the market could lose confidence. And that pressure pushed the company toward increasingly aggressive financial strategies. One of the most important figures in this story was Enron's chief financial officer, Andrew Fastow. Fastow designed a complex network of financial partnerships known as special purpose entities. These partnerships had innocent-sounding names and complicated structures. In theory, they were meant to manage risk and finance projects. But in practice, many of them served a very different purpose. They allowed Enron to move debt off its own balance sheet. If a project lost money, the losses could be shifted into these partnerships. That made Enron's financial statements look far healthier than they really were. Even more controversial was the accounting method the company used to report profits. Enron relied heavily on something known as mark-to-market accounting. Under this system, the company could record the estimated future profits of long-term contracts immediately. If Enron signed a deal expected to generate income over 20 years, it could book the entire projected profit right away. This approach allowed Enron to report large profits even when little actual cash had been earned. As long as investors believed those projections, the system worked. But if reality failed to match expectations, the accounting could quickly become dangerous. To maintain the illusion of success, Enron continued creating new deals and financial structures. Executives became masters of financial engineering. Losses were hidden, debt was moved off the books, profits were projected far into the future. For years, very few outsiders understood the complexity of the company's finances. Even many analysts who followed Enron struggled to explain exactly how the company made money. Yet the market continued believing the story. As long as the stock price kept rising, few people asked difficult questions. But by 2001, skepticism was beginning to emerge. One of the first journalists to raise concerns was Bethany McLean. In early 2001, she wrote an article asking a simple question: how exactly does Enron make its money? The question was surprisingly difficult to answer. Even executives struggled to explain the company's complicated business model in simple terms. At first, the article did not cause a major reaction, but it planted an important seed of doubt. Around the same time, Enron began reporting weaker financial results. Investors grew nervous. Then something unexpected happened. In August 2001, Jeffrey Skilling suddenly resigned as chief executive. The announcement shocked the market. Skilling had been the architect of Enron's strategy and one of the company's most confident leaders. His sudden departure raised serious questions. Kenneth returned as CEO in an attempt to calm investors, but the damage had already begun. Behind the scenes, Enron's financial situation was becoming increasingly unstable. Several of the off-balance sheet partnerships created by Andrew Fastow were collapsing. Losses were growing larger. Debt obligations were coming due. In October 2001, Enron announced a major charge against earnings and a significant reduction in shareholder equity. The company admitted that several partnerships had caused serious financial problems. Wall Street reacted immediately. The company's stock price began falling rapidly. Credit rating agencies started reviewing Enron's debt. Banks and trading partners began questioning the company's financial stability. As confidence declined, the situation worsened quickly. Within weeks, Enron's stock price collapsed. Only a year earlier, shares had traded above $90. Now they were falling towards zero. The company faced a dangerous cycle. As the stock price fell, investors lost confidence. As confidence disappeared, lenders refused to provide new financing. And without financing, Enron's trading operations could not continue. Executives desperately searched for a solution. One possibility was a rescue merger with the energy company Dynegy. For a brief moment, it appeared the deal might succeed. But as Dynegy examined Enron's financial records, the scale of the hidden problems became clear. The risks were simply too large. Dynegy withdrew from the agreement. At that point, the company's collapse was unavoidable. On December 2, 2001, Enron filed for bankruptcy protection. At the time, it was the largest corporate bankruptcy in American history. The consequences were devastating. Thousands of employees lost their jobs. Many also lost their retirement savings. Enron employees had been encouraged to invest heavily in company stock through their pension plans. When the stock collapsed, those savings vanished almost overnight. The scandal quickly expanded beyond the company itself. Investigators began examining the role of Enron's accounting firm, Arthur Andersen. Arthur Andersen had audited Enron's financial statements for years. Critics argued that the firm should have challenged the company's aggressive accounting practices. Instead, Andersen had approved many of the complex financial structures. The situation became even worse when investigators discovered that Andersen employees had destroyed important documents related to the audit. The controversy destroyed the firm's reputation. Within a year, Arthur Andersen effectively ceased operations. Meanwhile, federal prosecutors launched criminal cases against Enron's executives. Andrew Fastow eventually pleaded guilty to multiple fraud charges. Jeffrey Skilling was convicted of fraud and conspiracy after a lengthy trial. Kenneth was also found guilty, but died before he could be sentenced. The scandal shook the entire corporate world. Investors had believed Enron represented the future of business. Instead, it had become one of the largest corporate frauds in history. The political response was swift. In 2002, the U.S. government passed the Sarbanes-Oxley Act. The law introduced stricter financial reporting requirements and new rules designed to prevent accounting fraud. Executives were now required to personally certify the accuracy of their company's financial statements. Public companies had to strengthen internal controls and increase transparency. The goal was clear: prevent another Enron. But the deeper lesson of the scandal went beyond accounting rules. It revealed how powerful narratives can shape financial markets. For years, Enron had convinced the world that it had discovered a revolutionary business model. Investors wanted to believe that story. Analysts repeated the company's claims without fully understanding its finances, and executives became increasingly willing to manipulate numbers to maintain the illusion of success. The entire system depended on confidence. As long as the stock price rose, the story seemed real. But once doubt entered the market, everything collapsed. In many ways, the Enron scandal became a turning point in the history of corporate America. It exposed weaknesses in financial oversight. It showed how easily complex accounting could hide enormous risks, and it reminded investors that even the most admired companies can conceal dangerous truths. Today, the name Enron has become synonymous with corporate deception. Business schools study the scandal as a warning about ethics, governance, and financial transparency. Yet the story also offers a broader lesson about markets and human behavior. Financial bubbles and corporate hype often rely on belief. Investors believe in growth stories. Analysts believe in visionary leaders. Markets believe in endless innovation. But eventually, numbers must match reality. And when they do not, the consequences can be dramatic. For years, Enron convinced Wall Street that it was building the future of energy and finance. But behind the scenes, the foundation was fragile. When that truth finally emerged, the collapse was sudden and overwhelming. Billions of dollars disappeared, careers were destroyed, and one of the most celebrated companies in America vanished almost overnight. The illusion that had fooled Wall Street for years was finally gone, and the Enron scandal became a permanent reminder that even the most impressive success stories can hide a far darker reality.